Imagine waking up one morning and realizing the rules changed while you were asleep. Not the price, not the market hours, not the tax rate, the rules, the definition of what you own, the framework around it, the assumptions you built your strategy on. Nothing was taken from you, but suddenly what you thought was a personal financial decision is being discussed as a national priority, not emotionally, administratively, and that is always how real control begins. Here's the part that makes people uncomfortable. Governments don't need to seize assets to control outcomes. They only need to change incentives, access, and priority. When something becomes strategic, it stops being neutral. It becomes directional. And once direction is set, markets follow whether participants agree or not. Silver is quietly crossing that line, and most investors are still debating price targets instead of structure. This matters because history doesn't repeat loudly anymore. It updates quietly. The dramatic images people associate with the past are no longer efficient. Modern systems don't rely on confrontation. They rely on compliance pathways. That distinction changes everything about how risk shows up. It is January 25th, 2026. The global economy is not collapsing, but it is strained. Energy systems are under pressure. Supply chains remain fragile. Industrial policy is no longer theoretical. Governments are competing openly for manufacturing capacity, grid stability, and resource security. In that environment, materials that were once just commodities begin to look like infrastructure, and infrastructure attracts oversight. Silver is not being discussed because it is shiny. It is being discussed because it is useful, highly conductive, difficult to substitute at scale, embedded in energy systems, electronics, medical applications, defense hardware, and data infrastructure. When governments commit publicly to electrification, grid modernization, and technological resilience, they implicitly commit to securing inputs. Silver becomes part of that conversation whether investors like it or not. This is where most people make their first mistake. They assume that if silver ever mattered politically, it would look like a replay of the past. Same tone, same urgency, same blunt tools. That assumption is comforting because it gives people a clear villain and a clear timeline. It is also incorrect. Modern policy doesn't need blunt force. It needs leverage. Leverage begins with language. Strategic designation is not symbolic. It creates legal flexibility. It allows prioritization. It allows allocation. It allows regulation without triggering immediate resistance. Once something is strategic, governments can justify shaping flows rather than owning objects. And shaping flows is far more effective. When an asset is classified as strategic, it can be directed without being confiscated. Industry receives priority access. Defense contractors move to the front of the line. Infrastructure projects gain preferential supply. None of this requires touching private holdings. Liquidity tightens upstream. Dealer behavior changes. Reporting requirements expand. Export controls become plausible. The asset remains legal. The environment around it transforms. That transformation is what catches people off guard. Silver's supply profile makes this even more important. Unlike currency, silver cannot be created on demand. Much of global silver production is a byproduct of other mining operations. That means output does not respond quickly to price signals. Permitting takes years. Development timelines stretch. Refining capacity is finite. For decades, the system relied on inventories and recycling to fill gaps. That works until it doesn't. When industrial users sense future tightness, they don't wait. They secure supply early. They lock in contracts. They build buffers. That behavior alone can create the conditions people insist are impossible. Strategic attention often appears before visible shortages because policymakers watch these signals long before the public does. This is not a single country issue. Silver supply chains are global. Mining jurisdictions are concentrated. Refining capacity is unevenly distributed. Industrial demand is expanding across multiple regions simultaneously. When geopolitical tension rises, materials that enable infrastructure and defense become bargaining chips. Not because they are rare in absolute terms, but because access matters more than abundance. Policy does not arrive as a headline. It arrives as a sequence, a technical memo, an agency update, a compliance clarification, a temporary measure, then an extension, then normalization. The risk is not the first step. It is failing to recognize the pattern before options narrow. To understand what could happen, scenarios must be separated. The first is outright confiscation. Blunt, politically explosive, difficult to enforce. The second is flow control, priority allocation, dealer regulation, compliance burdens, and industrial favoritism. Quiet, scalable, and realistic. The third is financial pressure. Taxes, reporting thresholds, transaction limits, and incentives that guide metal into preferred channels without ever using the word seizure. Most discussions fixate on the first scenario because it is emotionally charged. Real systems prefer the second and third because they work. History does not teach repetition. It teaches adaptability. In crisis, rule books bend in the direction of stability. That stability is defined by those in power, not by markets. Legally, many governments already possess broad emergency authorities. Practically, enforcement follows efficiency. Seizing small private holdings is inefficient. Volume exists upstream. Mining output, refining streams, industrial inventories, institutional stockpiles. That is where pressure concentrates first. Individuals are rarely the starting point, but broad rules can still affect them indirectly, especially when written expansively. Consider realistic measures. Mandatory reporting for large transactions framed as market transparency, temporary export restrictions during supply disruptions, government procurement programs that outbid markets for industrial-grade material. None of these confiscate personal silver. All of them reshape availability, premiums, and liquidity. This is where fear narratives become dangerous. Some voices exaggerate worst-case scenarios to provoke rushed decisions. Fear compresses judgment. People overpay, people concentrate risk, people mistake urgency for strategy. Silver should be owned deliberately, not emotionally. Modern systems exert control over transactions more easily than objects. Payments, reporting, tax treatment, dealer licensing, transport rules, insurance requirements. Friction becomes enforcement. Most people comply because resistance is costly. The triggers for increased control are consistent. Supply shocks that threaten politically important goals, currency confidence events that push capital toward hard assets, geopolitical fractures that elevate resource security. One is enough if framed correctly. Silver's dual identity makes it especially sensitive. To the public, it is a monetary metal. To policymakers, it is an industrial input. That ambiguity allows intervention to be framed as protection rather than restriction. Meanwhile, the market itself sends signals. Volatility, premium spikes, product delays, spread distortions. Spot price alone never tells the full story. If authorities needed silver urgently, they would not chase households. They would secure contracts, subsidize refining, mandate priority allocations, and manage exports. The real risk is not dramatic seizure. It is gradual structural change that shocks those who are watching charts instead of context. This is not a prediction. It is a framework. Understanding how power actually operates prevents surprise, and surprise is the most expensive risk of all. Hold this foundation, because the next section connects these dynamics directly to modern financial control, currency confidence, and what rational positioning actually looks like when policy becomes a market factor. Now we need to confront the part of this discussion where emotion usually replaces analysis. The moment people hear government involvement in precious metals in the same sentence, their mind jumps to one conclusion: confiscation, a repeat of the past, a sudden event where ownership is stripped and rules change overnight. That mental shortcut is understandable, but it is not how modern systems actually operate. Today, control is exercised through structure, not spectacle. The most important thing to understand is that modern governments do not think in terms of assets the way individuals do. They think in terms of flows, inputs, bottlenecks, dependencies. When policymakers look at silver, they are not asking who owns it. They are asking where it moves, how reliably it moves, and what happens if it stops moving at the wrong time. That distinction changes everything about how intervention unfolds. If you look at how policy has evolved over the last 20 years, the pattern is consistent. Authorities prefer tools that influence behavior indirectly. They shape incentives, compliance requirements, and access conditions so that markets self-adjust in the desired direction. This approach avoids confrontation while achieving control. It is quieter, it is cleaner, and it is far more effective. This is why emergency powers are often misunderstood. Emergency authority does not exist to guarantee confiscation. It exists to guarantee optionality. It gives governments the ability to respond quickly when delays are politically costly. Speed matters in crisis, and speed favors frameworks that already exist. Across many countries, there are standing mechanisms that allow governments to prioritize defense production, intervene in supply chains, regulate critical materials, and control certain financial flows during emergencies. These mechanisms do not need to be invented. They only need to be activated. And activation rarely looks dramatic at first. Now let's ground this in practical reality. If the objective were to secure silver for industrial or infrastructure purposes, what would be the fastest and least disruptive path? It would not involve tracking individual holders. That would be inefficient, unpopular, and logistically unnecessary. The volume required to support grids, manufacturing, and defense systems exists upstream. That is where leverage is applied. Governments can offer long-term contracts to producers. They can subsidize domestic refining. They can mandate priority fulfillment for certain industries. They can restrict exports during periods of stress. They can impose additional compliance requirements on large dealers. Each of these actions alters market behavior without touching private safes. Ownership remains legal, but access, pricing, and liquidity change. This is where people misinterpret risk. They think risk only exists if something is taken. In reality, risk exists whenever optionality is reduced. When the number of available choices narrows, exposure increases even if ownership remains intact. That is the form policy risk usually takes. Now consider how this interacts with market psychology. Silver already has a reputation for volatility. It moves sharply, then stalls, it attracts attention, then fades. This behavior causes many investors to underestimate it. They see chaos rather than signal. But volatility is often how constrained markets communicate stress. Tight systems rarely move smoothly. They move in bursts. When supply is fragile, signals appear in places most people ignore. Premiums diverge from spot. Certain product forms become scarce. Delivery times extend. Dealer policies change. These are early indicators. Policy attention tends to follow them, not precede them publicly. Another misconception worth correcting is the idea that silver's importance is static. It is not. Its relevance increases as systems become more electrified and data-driven. Power transmission, high-reliability electronics, and specialized industrial components all depend on materials that perform consistently under stress. Silver's properties make it difficult to replace entirely, even when engineers try to thrift usage. This creates a slow pressure effect. Demand does not explode overnight, it accumulates. Meanwhile, supply struggles to expand at the same pace. That imbalance is exactly the kind policymakers monitor quietly. Now let's talk about why the year 2026 matters. We are in a period where governments are openly competing over industrial capacity. Manufacturing is no longer treated as a purely market-driven activity. It is treated as a strategic asset. Energy independence, technological resilience, and defense readiness have become political priorities across multiple regions simultaneously. At the same time, electricity demand is rising faster than expected. Data centers, artificial intelligence infrastructure, and electrification initiatives are stressing grids. Grid modernization is no longer optional. It is required to maintain economic stability. These systems are built from materials. When materials become constrained, policy responds. Defense adds another layer. Military procurement does not tolerate uncertainty. Delivery guarantees matter more than price. When geopolitical tensions rise, defense budgets expand, and supply security becomes paramount. Silver's role in high-reliability components places it within that orbit, whether markets acknowledge it or not. Now shift perspective to the individual level. Many people hold physical silver precisely because it sits outside traditional financial infrastructure. It feels tangible, independent, less exposed to counterparty risk. That appeal is real. But it does not eliminate policy exposure. It changes the form of exposure. Physical ownership reduces reliance on digital intermediaries, but it introduces other constraints: storage risk, security risk, liquidity friction, and in certain scenarios, regulatory friction. None of these are reasons to avoid physical silver. They are reasons to understand it honestly. One of the most damaging narratives circulating is the idea that governments must choose between total confiscation or total inaction. Reality is far more nuanced. Governments usually pursue the path of least resistance. That path often involves taxation, reporting requirements, transaction thresholds, and regulatory tightening rather than dramatic seizures. In fact, many jurisdictions already have reporting rules around precious metal transactions. Expanding or enforcing those rules is far easier than introducing new ones. That is why realistic forecasting begins with existing frameworks, not hypothetical extremes. Preparation, therefore, should focus on flexibility rather than fear. Flexibility comes from clarity of purpose. Why do you own silver? Insurance behaves differently than speculation. Insurance is not designed for frequent trading. It is designed to be there when conditions deteriorate elsewhere. Flexibility also comes from liquidity planning. If circumstances required partial conversion, do you know how that would occur? Through which channels? Under what conditions? Planning removes urgency. Urgency is what forces poor decisions. Diversification matters here as well. Concentration amplifies stress. Metals are a tool, not a belief system. They perform best as part of a broader strategy that anticipates multiple risks simultaneously. Another element often ignored is substitution and innovation. When materials become constrained, engineers work aggressively to reduce dependence. Solar manufacturers reduce silver content per unit. Electronics designers alter architectures. These efforts do not eliminate demand, but they change trajectories. Demand becomes more elastic. This moderates extremes but does not remove policy interest. This dynamic is why absolute claims fail. Silver will not be ignored. Silver will not be universally seized. The future exists between those outcomes. Policy involvement increases as stress increases. The form that involvement takes depends on political cost, feasibility, and narrative framing. Now consider the role of currency confidence. When trust in fiat systems weakens, people seek alternatives. Hard assets attract flows. When those flows accelerate, authorities respond. sometimes by tightening monetary conditions, sometimes by easing them, sometimes by restricting capital movement, and sometimes by focusing on the escape valves themselves. Physical metals can become an escape valve, not because they are illegal, but because they function outside the core system. When enough people move at once, that movement becomes a signal, and signals provoke policy. Watch the sequence carefully. Economic stress rises, demand for physical assets increases, premiums widen, availability tightens, language shifts toward stability and protection, policy attention follows, control mechanisms emerge. This is not speculation, it is pattern recognition. The key question is not whether intervention will happen. The key question is how it will happen. Loud interventions invite backlash. Quiet interventions achieve compliance. History suggests which one policymakers prefer. This is why resilience matters more than prediction. Resilience means you can absorb volatility without panic. You can adjust without being forced. You can wait while others rush. That is real optionality. Avoid common mistakes. Do not overpay extreme premiums driven by fear. Do not create liquidity traps where selling becomes urgent. Do not neglect security. Theft is the simplest form of loss. Do not assume digital assets are immune either. Every asset has vulnerabilities. This discussion is not about telling you what to do. It is about giving you the framework to interpret what you see. When policy becomes a market factor, charts alone are not enough. Context becomes critical. Hold this framework. Because the final section ties these dynamics into a clear strategic mindset and explains how to think about silver rationally as policy pressure increases without surrendering to extremes. Now we step back and connect everything, not emotionally, not ideologically, but probabilistically. The mistake most people make when policy risk enters the picture is believing the future must resolve into a single dramatic outcome. Either governments take everything or nothing happens at all. Real systems do not move that way. They shift gradually, unevenly, and often under language that sounds protective rather than restrictive. That is why direction matters more than timing. Silver's elevation into strategic conversations does not mean intervention is guaranteed. It means optionality has expanded for policymakers. Optionality is the real objective, the ability to act quickly when circumstances demand speed. Speed becomes valuable when systems are strained. Energy infrastructure, defense supply chains, industrial throughput, and currency confidence all intersect during stress. When that intersection tightens, policy does not improvise. It activates existing frameworks. Modern control rarely looks like force. It looks like friction. Access changes, costs change, procedures change, behavior adapts. Most people comply not because they are coerced, but because compliance becomes easier than resistance. That is how control functions without spectacle. The key distinction to understand is between ownership and usability. You may legally own an asset while finding it increasingly difficult to transact, insure, transport, or convert efficiently. That gap is where policy operates most effectively. Legality remains intact, outcomes shift. This is why fixation on confiscation misses the larger risk. The more realistic threat is constraint. Market psychology amplifies this effect. Markets react not only to events, but to expectations. When investors sense policy involvement, behavior shifts. Hoarding increases, liquidity thins, premiums widen, availability fragments. Those reactions themselves become justification for further intervention. Policy responds to behavior. Behavior responds to policy signals. A feedback loop forms. This is why early awareness matters. Not to panic, but to avoid being forced into reactive decisions. The people who suffer most during structural transitions are not those who planned conservatively. They are those who anchored to a single narrative and refused to adapt as conditions evolved. Silver in 2026 sits at an uncomfortable intersection. On one side, it remains a store of value, a hedge against monetary instability, and a tangible asset outside purely digital systems. On the other side, it is an industrial input embedded in systems governments have publicly committed to expanding. Energy grids, data infrastructure, defense electronics, medical technology. These systems do not tolerate supply uncertainty. When uncertainty rises, oversight follows. This brings us to an uncomfortable but necessary question. In a genuine emergency, what does responsible policy look like? Market purchases, incentivized sales, priority allocation, temporary controls. None of these tools are inherently malicious. They are instruments. Instruments can be used responsibly or abused, depending on governance, transparency, and accountability. This is why trust becomes central. People do not fear mobilization itself. They fear mismanagement, permanence, and unequal enforcement. History provides examples of all three. That history justifies skepticism. It does not justify paralysis. The rational stance is conditional trust paired with vigilance. Assume frameworks will be used, watch how they are applied, adjust exposure accordingly. Resilience at the individual level comes down to optionality. Optionality means you are not forced to act under pressure. It means you can wait when others rush. It means you can observe rather than react. Optionality is created through liquidity, diversification, and clarity of purpose. If silver is part of your strategy, it must have a defined role. Insurance behaves differently than speculation. Insurance is not optimized for short-term gains. It is optimized for long-term stability. When people treat insurance like a trade, they become disappointed and reactive. When they treat it like insurance, they remain calm when volatility arrives. This distinction also reframes expectations around price. Silver is volatile by nature. It overshoots, corrects, stalls, and surprises. Strategic attention does not remove volatility. It can amplify it. Price spikes do not automatically indicate shortage. Shortages often appear first in form, availability, and spread distortions. Jurisdictional differences matter more than many realize. Policy responses vary widely across regions. What applies in one country may not apply in another. During stress, global markets fragment, arbitrage narrows, regulatory asymmetry increases. Understanding where you operate becomes as important as what you own. At the same time, global coordination has limits. Heavy unilateral control invites retaliation. International trade relies on reciprocity. This constraint reduces the likelihood of extreme centralized pricing controls. Again, this favors gradual, layered intervention over dramatic action. Political cycles also matter. Governments are not unified actors. Agencies compete. Priorities clash. Outcomes are often compromises. This internal friction slows extreme measures while increasing complexity. Complexity confuses the public, which ironically reduces resistance. Strategic classification rarely produces immediate consumer impact. It sets the stage, effects surface later, often during unrelated crises. People connect the dots only in hindsight. That is why preparedness must precede headlines. Preparedness does not mean hoarding. It means proportion, balance, awareness that no asset exists permanently outside policy influence. The goal is not immunity, it is adaptability. Certainty is seductive, but rarely honest. Anyone offering guaranteed outcomes is simplifying complexity for effect. The future of silver depends on interacting variables. Policy, technology, geopolitics, market psychology, and substitution all matter. That is why scenario thinking is more useful than prediction. What if demand accelerates but substitution increases? What if policy intervenes lightly? What if intervention escalates? What if currency confidence weakens? Each scenario suggests different responses. None require panic. Personal risk must not be ignored. Job disruption, health expenses, unexpected obligations. These forces cause forced selling at the worst times. Resilient strategies anticipate household volatility as much as systemic volatility. Security also matters. Physical assets require responsibility. Loss through negligence is permanent. Policy risk is abstract. Theft is concrete. Confusing importance with complexity leads to mistakes. Digital systems have vulnerabilities as well. Regulation, access controls, surveillance, and platform risk exist there too. There is no perfect refuge, only trade-offs. All of this leads to one conclusion. Strategy must replace ideology. Assets are tools. Tools must fit context. Context changes. Silver's strategic relevance increases attention. Attention increases policy involvement. Policy involvement increases uncertainty. Uncertainty demands planning. The appropriate response is neither blind accumulation nor blind rejection. It is thoughtful integration, monitoring language, observing structure, remaining flexible. If you are waiting for a single announcement to guide your decisions, you are already late. Systems evolve through accumulation, not declarations. The next major crisis may not center on banks. It may center on energy, infrastructure, or geopolitics. When that happens, the assets prioritized by the system will reflect that origin. Monetary history teaches this repeatedly. Control follows necessity. Ask yourself one final analytical question. If stability becomes the dominant narrative, which assets will be protected and which will face constraint? The answer reveals where pressure concentrates. Silver exists between those categories. That tension is the signal. Understanding it does not require fear. It requires attention. And attention, applied early, is the most valuable asset you can hold.